In segment 2, we want to provide a bit more depth on just the GDP backdrop, and then take that and look at the GDP side and then correlate that down to PMI. What is happening with some of the leading indicators, and what does that look like as we head into November? So when we look at, this is, I think, a great chart that I wish I could have made. Because one of the things that we've been talking about is the law of diminishing returns. So when we look at law of diminishing returns, you have to look at what does the incremental nominal GDP from each dollar of additional debt give you. And that's when you see that downward trajectory where dollar increase in GDP per dollar increase in non-financial debt, 4-quarter moving average. So you get an idea since 1962 what that additional value has purchased. And that's the underlying problem, where when you look at the higher, mostly federal debt and less nominal GDP per dollar of new debt, you get an idea of how that trend is continuing to move. And we keep getting closer and closer to that negative contribution. And I think that is the biggest piece of so this chart is saying that by 2040, we'll have negative contribution. And I think that's, again, this is who knows how fast that'll happen, because we've seen it go negative in 07 through 08, it went negative again. So there's some of that backdrop. It's just the bounce off the bottom is getting softer and softer because we keep over leveraging ourselves. And we've seen this break many countries before. And you're getting an idea of how that continues to converge. And this is just saying insolvency by 2040 based on the trend. Again, insolvency and what that means in terms of just general growth. A lot of things can happen between now and 2040. I mean, we can invent something. We can find the importance of not having so much debt. There's a lot of things that can happen. But this is just looking at the general growth factor. And you can see that when technology really caught up, you had this kind of flat line. And you saw that from really 86, if you will, 89, straight through to the financial crisis, to the tech bubble. And then you kind of got back to it. So there's a way to adjust this. But you can see that even new industry coming out, if you keep borrowing at the same rate, the new industry will provide some stabilization, but you need to take that opportunity to pay down debt, cut spending, take in some of this, refill the coffers, and really adjust where this trend is going. But so far, clearly you can see how this really plays out. Then when you look at the U.S. economy, so again, we're not going to go through this too much. We went through it a lot last week. But when you look, the GDP at 1.4%, again, consumer spending, the big part of it with the durables and non-durables being the largest percentage of it. But you can see services is a big piece of it. So which is why consumer spending was only at 3.5, even though the breakdown durables and non-durables. So as you see more services coming back, more of that durables, non-durables coming down, you'll still be able to maintain a fairly strong consumer spending, especially as we go through Q4, because services is coming up. The problem's going to be what happens with inflation, what happens with spending as inflation continues to be elevated. And then fixed investment remained strong. Exports, absolutely terrible, and that's something that's going to stay weak as government spending has fallen again. So as we go into Q4, you're going to have more of a negative contribution from that as fixed investment also starts to come down a bit, as equipment and IP investment comes down, but structures are getting some love, so you'll get some of that adjustment, but again, still net falling in general. So then when we look at U.S. imports, so U.S. imports, I think this is important to see where is it coming from, because when you look at July and August, about 19% from China, about over 5% from Japan, 11% from the ASEAN, 25% from Europe, Canada, Mexico. So clearly, as all of these countries continue to see their PPIs surge, you're going to get an idea of who's going to be importing a lot of that inflation, which is going to come through in these different levels. So when you look at U.S. real GDP to get you an idea of kind of where that trend is, we're still well off that trend that we've set from 2017 into 2019. But look at where 2019 is. And this is what I always want to come back to. 2019 was not a strong year, and you saw a lot of these pivots down. Obviously, 2020 led into the COVID situation, but things were already starting to crack a bit. So now we're back above that level. But but look at how things are starting to level off as inflation continues to ramp. The real GDP number, which is when you're taking out that inflation, becomes more of an issue, especially as wages, though going higher, are not really keeping pace with just the level of inflation that we've been seeing. And then on the other side, inventory's contribution to GDP growth was at 2%. This is something that is going to be lumpy. And we've talked about this. Inventories, you don't want to put too much cash in inventory, so you're going to try to manage your price. But this is something that is going to be important as well to watch as consumer spending contribution to GDP leveled off. But we do expect to see some of that come back in October. But the question is going to be November and December, where we see some of that slowdown on the consumer, as a lot of it was pulled into both September and October. Which is why when you look at the contribution to real GDP, just putting it simply, inventory had a nice positive benefit. Business investment was negligible. That will reverse. Net exports will remain a drag. But that inventories is kind of be a bit of that swing, because I think inventories are going to address less in Q4 and the consumer a bit more based on how October went and where, obviously this is Q4, this is a holiday season. So you get some of that benefit, but you get an idea of what that trend looks like and how inventories can be lumpy. But then when you look at, again, that contribution to federal fiscal policy, this is where that growth comes down, and you get that lag, which is why we see those government transfers and that government spending being a net drag on Q4 GDP as well as through 2022. And then the contribution of foreign supply chain to U.S. final demand. So when you look at where things are coming from, this gets an idea of just how inflation is still coming through and how it's going to be very difficult to manage that, because you can say, well, construction is obviously mostly U.S., but where do the products come from? Where does the steel come from? The lumber? All of those pieces. So this is just one piece of that pie, but just shows how exposed we still remain for a large portion of what we consume on a daily level, like the basic metals. When you look at how much is domestic, well, how much of that goes into construction, electrical equipment, how much of that goes into computer and electronics, into the chemicals and pharmaceutical products. So again, all of these pieces, and then food products, beverages, and tobacco. It's still a global commodity, so there's going to be a global clearing price. And we're not putting up gates right now to stop some of these exports, to give you an idea of just where and how some of this is going to impact the U.S. consumer. So all of this, when you start putting it together, the CFO optimism continues to come down. And we've talked about this already for Q3, but yet when you look at just where the S&P 500 is, as we make a new all-time high following Powell's comments, you get an idea of where this bifurcation sits in the underlying market in general. And then when you look at credit, credit has started to roll over. When you look at where some of the movements are on the curve, the 10-year has spiked. You're starting to get a bigger move in the long end of the curve. So you're starting to get some of this bearish steepener. But yet, when you look at what the equities have done, they've just been essentially a massive bullish tailwind, where credit normally leads equities, but here you've seen how credit is really kind of shaken off what has happened so far. So now when we look at that, and let's look at what has happened with ISM. So purchasing managers report very strong demand conditions, but supply chain disruptions, material shortages, and labor shortages, they mean that they are unable to adequately respond to the strong demand, especially in the higher inflation environment. So one of the things that and the reason why I like this chart so much from Greg and Oxford Economics, you get an idea of what supplier deliveries add to this, what employment adds, business activity. So when you take out that supplier delivery side in terms of what is that driving and how those delays are providing a positive look, but really shouldn't be as positive, you can see that it's still strong. but it's come down to about that low 60s, which is really where we said things were going to be in terms of October. Our view is that October was going to be very strong, as you saw a lot of this spending essentially pulled forward into this month, or the previous month, and that's going to leave November a bit naked. And especially when you look at input prices, when you look at pricing in general, people are going to shy away from just how elevated a lot of these costs are. So then when we look at the prices paid, sees the longest expansion since prior to the financial crisis. So you can see that here, going back through into the 90s, this is the highest it's ever been for ISM prices paid, and even though we had a small step back, now you have this reacceleration, which is why when we look at Q3, our whole comment was like, look, it did slow down. We talked about it slowing down. It slowed. The pace slowed. It never went away. The pace slowed, but now we're getting a reacceleration, which is creating, I think, some of these additional pressures, which is why when you look at stronger ISM services in October, up to 66.7, which is a record high versus the estimate of 62, much closer to where we were. Prices paid climbed to 82.9, new orders up to 69.7, deliveries lengthened to 75.7, and inventory sentiment dropped to 37.3. Employment ticked down but remained in expansionary territory. New orders rose to 69.7 versus 63.5, highest since 1997. So this is where employment is still there, but you're still struggling to find people, and what wage are you willing to pay? And that's why when you look at this massive spike in the ISM services, a huge part of that is driven based on supplier delivery times that is driving that delta between what I think estimates were and where. Now, given we've been talking about how bad the supplier delivery system is, this just happens to be even worse. And you know us, we've been all over this and been very adamant about how bad it is. This is even worse than our expectations, to give you an idea of what pain there is in the market. And then when you look at some of the leading indicators, again, the Kansas City Fed, this is coming back to what we talked about last week. Actual 31, survey was 20. So things are getting a bit better on the manufacturing side. CapEx, getting a bit better. This is going to be that nice tailwind when you look at 2022, because you're going to have investments in here, and this is all to replenish. Even if consumers don't buy, companies have to buy. You have inventory shortages. So that will help, again, provide some of that boost even as the consumer slows. The fiscal drag is there. You'll have some of that offset based on some of these economics. And then when you look at manufacturing supplier delivery times, all-time high. Prices paid for raw materials, back to all-time highs. And all of these things lead to more inflation. Again, there's nothing in here that is showing this is transitory. There was a pause, now a reacceleration. Nothing here is showing that it's going away because, again, they paid it, they're going to try to receive it, and that's going to try to get passed through the system. Which is then when you start looking at U.S. cycle lead index, you can see where the U.S. cycle lead index is, where ISM new orders are. So they're starting to roll over, and you get an idea of just what that pull down is going to look like, which is why we're talking about more of a late cycle than a front end cycle. But you can see there's a lot of congestion at the top, which is why we've been talking about manufacturing is not going away anytime tomorrow. This isn't like, oh man, you look at this, like look forward, it's going to collapse. It's like, no, there's inventory that needs to be replenished. There's businesses that need to try to function, and there's still a consumer that's willing to spend. The delta is going to be, when does the consumer give up? And our view is that that's going to start in November and accelerate through this year, and then again, it really continue that acceleration, excuse me, in Q1 of 2022. And that's why when we start looking at the economic confidence index, you can see it's firmly negative. And the economic confidence index is an average American's net ratings of current economic conditions. And things have continued to deteriorate as, again, inflation goes up, prices go up, and you get some of these underlying fears. Americans' mentions of economic issues as most important has risen to the highest it's been since essentially the beginning of October. So you get an idea of where that economic impact And even though jobs are plentiful, you're still getting these fears because how are you going to be able to see these wages go up if these pressures continue to mount? Because positive assessments of the U.S. job market, it's the highest it's ever been. So there's no concern on the job side. It's what am I going to get paid? What is my wage going to be? What are my savings going to look like? What is my portfolio going to be? How am I going to be able to live based on these rising living wages? That's the biggest concern, not the job market, but what does the job pay is the underlying question. Which is why when we look at ISM manufacturing PMI, here's that 60.8 that it came in at, right around where expectations were. You can see it's a bit below where we have been at the peak. But when you look at report on business prices index, it's shifting back up, 85.7. When you look at report on business new orders are dipping now, 59.8. When you look at report on employment, again, stable at that 52, which is why we should have a decent jobs number for September. The question will be, for October, the question will be, what does November look like? And here's where you can kind of get an idea on the bifurcation where services remain the driver. We've been saying services are the driver. We expect goods to slow, and you're continuing to see some of that underlying backdrop. So then when you look at some of the good commentary from Chris Williamson, October saw U.S. manufacturers report yet another near-record lengthening of supply chains, with shortages of components constraining production growth to the lowest since July of last year. Around half of all companies reporting lower production in October attributed to the decline to lack of supplies. However, a further 1 in 10 cited a lack of labor, and 1 in 4 reported that demand had fallen, often as a result of customers either lacking other inputs or pushing back on higher prices. So you're starting to see that grow in the underlying market. Although production growth has now slipped below the pre-pandemic long-run average due to the supply and labor conditions, demand growth as a measure of by new order inflows remains well above trend despite easing in October. Hence, producers saw another steep rise in backlogs of uncompleted work. This shortfall of production relative to demand was the principal driving force behind a survey record rise in manufactured selling prices. All of this is inflationary. So you're seeing some of that slow down, some of the good, some of the bad. But net, it's inflationary. Again, there's stop, period, end. Inflation is inflation 101, which is why we see those pushing higher. And the drop in ISM orders minus inventories is sub 50. Minus inventories is coming down. You can see it's now coming into zero. So the question is how much does this pull down ISM in general, which again is not something that's going to drop instantly, but you're seeing that downward pressure, you're seeing kind of that peak end of the cycle in general. And this is just looking at, again, just graphically, that ISM manufacturing PMI. So it dipped to 60.8 versus the estimate of 60.5. New orders fell sharply, but still expanding. Production eased a touch. Inventories improved and exports ticked up. So you get an idea of kind of what this looks like and how we're starting to congregate. But that drop in new orders is the biggest concern because now you have the backlog. Why am I going to have new orders? And you saw that play out first in China as just an example before you saw that drop. So this is something very similar playing out. And that's why when you look at those new orders, survey was for 64.2, came in at 59.8. Orders to inventory ratio dropping to the lows that we saw. But again, nothing too crazy yet. The question is, what is this going to become as we get back to this level? Because it's not because inventories have gotten better, but it's because orders have gotten worse, which is why inventories will remain a bit of that tailwind. And then imports, imports are coming down again with supplier deliveries. So you're starting to see, look, the imports are coming down. It's in the system. It's somewhere. I'm waiting for it to show up. So there's no need to go out and rush and buy more. And this is when you look at the average commitment lead time for capital expenditures is now at 156 days, the longest it's ever been going back to 2005, which is why when you look at the ISM manufacturing PMI data, inventories remain strong, but that supplier delivery, if you take away or normalize, just taking it down to what it should be, we're at 55. And that's, again, a good number. That is not a bad number. It just shows how much of this is being influenced and how growth is really is really at a different rate than what some of these are, because that supply deliveries is actually negative. Some of these issues are a negative side, which is then driving some of that inflationary fears, some of those pressures, which again leads to those underlying issues in total, which is why total construction spending, continued to normalize. Non-residential starting to pick up, as we talked about fixed investment, but residential starting to come down as people balk at those prices, which is where you look at U.S. average hourly earnings, low wage continuing to spike up, but that high wage coming down, that middle wage starting to level off, and you're seeing this underlying pressure where how are these wages need to continue to go up to match with what inflation is. And that's where we see these pressures. That's where you're still not seeing real income growth, because we're just not seeing that pass through as inflation continues to drive higher and just surpass even the most normal estimates in general, because we keep seeing this lockstep up, which again is going to keep pressure, even though Powell is going to maintain his transitory statements. So now in the next segment, we're going to talk about how this and others lead to that consumption pattern and what we see happening so far in November.